Good afternoon, everybody, and welcome to the latest Urban Living webinar. I feel like I've just emerged from the souks of Marrakesh to talk to you all about the hospitality transaction market. That was another spectacular music choice from our marketing team, so thank you for that. So today's topic is the hospitality transaction market. My name's George Sell. I'm Editor-in-Chief at International Hospitality Media, and we are a publisher of B2B news websites for the hospitality and real estate industries, and we also organise events, conferences and award schemes. Now, this Urban Living webinar series is sponsored by Flywire and Charles Hope Apartments, and we are going to find out a bit more about both of our sponsors with some short videos, and you can also see their contact details in the chat.
Flywire helps travel businesses reduce costs and improve guest experience when collecting payments. Without Flywire, travel payments can be costly and inefficient, requiring the business to work with multiple vendors like payment processors, merchant banks, and more. The process results in difficult manual reconciliation, high fees on both sides of the transaction, and no dedicated support for payers or merchants. We solve these pain points through our Flywire Advantage, the combination of our next-gen payment platform, our proprietary global payment network, and our travel-specific software backed by our deep industry expertise to improve both sides of the payment equation. Guests pay in their local currency and with their preferred payment method, whether it be credit card, local bank transfer, mobile wallets, or other local payment methods. Flywire leverages our significant scale to ensure travel businesses and guests alike enjoy low fees and competitive exchange rates. Businesses receive the exact amount that they bill in the currency of their choice for both domestic and international payments, all reconciled to the penny. If there are any questions along the way, Flywire's around-the-clock multilingual support and dedicated account managers are there to help. To learn more, visit travel.flywire.com and request a demo today.
Okay, thanks to Flywire. And our next sponsor is Charles Hope, and we've got another short video to show you. So thanks to Flywire and to Charles Hope, and as I said, you can see more in details about how to contact them in the chat. So today's session is going to be an hour long. We want to make it as interactive as possible, so if you do have any questions, please submit them using the chat or the Q&A function in Zoom. Everybody who is registered for the session will get a link to a recording of it in the next couple of days. So just wanted to show a few screen grabs from our editorial websites, which touch on some of the types of transactions that we're going to be talking about in the sessions. We've got a camping acquisition there, a park holidays company, which is quite a hot space at the moment. Extended stay in the US, there's been a huge amount of investment in there. And a very recent one, Bespoke Hotels, has just acquired a portfolio of 4 Scottish hotels, I believe. Single asset acquisitions, as with the Limestone Capital there, those guys are quite acquisitive. They're making fairly regular purchases. And as you can see on the right-hand picture, last year was a strong year for single asset UK hotel deals, presumably driven by the staycation business, and we're going to find out if that's the same this year or if things are changing. So we've got a great panel here to talk about what's happening in the transaction market. I'm going to ask the guys to introduce themselves in turn, and we'll go from left to right as we see them on the screen. So firstly, Tom, good afternoon to you.
Hi, good afternoon, George. I wear a few hats, so I'll be as brief as I can. But through Hilltop Hospitality, I work with a number of investors in originating hotel transactions. So principally on the buy side, I also do some sell side work as well. I'm also a consultant with Cheval Collection, looking to grow their service department business throughout the UK and Europe. And I'm also a senior advisor to Alvarez and Marcel to help their hospitality business expand.
Thank you, Tom. Lee, good afternoon to you.
Yeah, hi, George. Good afternoon. So my name's Lee Pemberton of Azure Asset Management. So I've been operating, managing, developing service departments and hotels for the past sort of 20 years. My main focus now is with Azure Asset Management, where we have a platform that we've developed where we source, design, build, and create sustainable hotels within central London. So typically taking family 3-4-star hotels, family operated hotels, and then being able to repurpose that space and create value for our private equity funds and our operating partners.
Thank you, Lee. And finally, Andrew, good afternoon to you.
Well, good afternoon, everybody. Andrew Harrington, at AHV Associates, an investment banking boutique based in London, 21 years old. I own the business. We've got 3 full-time staff. We focus on M&A and capital raising in the hospitality space, with a focus very much on privately owned businesses. Don't come from a real estate background, come from an M&A background, but obviously that incorporates quite a lot of understanding of real estate.
Thanks, Andrew. You can see the LinkedIn profiles for all our speakers in the chat, so if you want to connect with them, please do so. And Andrew, I'd just like to stay with you for a moment for the first question. So where are we at in terms of transaction volumes now compared with pre-pandemic, and what is the general direction of travel?
It depends what statistics you look at, George, to be absolutely honest, and we'll only really know what is happening like in a couple of quarters when the statistics are compiled by credible parties. But certainly, I suspect the level of transactions overall, I mean, a lot's not reported. I suspect the level of transactions overall is below where it was in 2019, certainly higher than last year and the year before. But what is interesting is, you know, the different types of transactions that are taking place. I mean, there's a lot going on, for example, in extended stay, right? There's a lot going on in staycation. There's a lot going on in Southern Europe, in the holiday destinations of Southern Europe. And there's a lot going on in something which we've been active in, which is called thematic investment partnerships. And, you know, LaSalle's teaming up with Numa is a good example of that, whereby there's a backing given to an operating company in order to acquire real estate to support a particular strategy. There's the C1 and Frogmore relationship, which we were involved with. Again, you know, that's a similar sort of thematic investment. So we're getting new types of structure. I mean, it all boils down to the fact there's masses of money around and massive amounts of money around, and there's some real themes that have emerged in the last few years that are sustainable and are very attractive. I mean, talking about sustainability, the next thing, and we're starting to see this big time right now, is the whole ESG stuff. And we've, as you know, George, we've talked a lot about this and we've done research on this. So, you know, I don't know whether the aggregate amount is higher than 2019. I don't think that's particularly helpful, actually. There's certain themes emerging, and I think we're going to see more of those, for the rest of the year.
Thanks, Andrew. Tom, do you want to run us through some of the major transactions of recent months, which may give us an idea of some of the themes that Andrew is talking about, and maybe some others too?
Yeah, no, certainly I will. Again, just in terms of sort of numbers, it's hard to say where we're at today versus 2019, but in the deals that Hilltop Hospitality tracks year to date, we're probably between 40 to 50% up on last year. So I think that's a really positive trend that we're seeing. We're seeing more transactions, we're seeing more assets coming to market. We've still got a widening pool of capital, as Andrew mentioned. The LIM Naveen partnership, LIM and that partnership is one example. but we've also got PGIM, who have partnered with Handers to invest in the sector as well. So these new partnerships are going to be quite important going forward. In terms of actual deals, one of the most sizable deals we've seen is the sale of Point A hotels in the UK at a headline price of 420 million, although one of the major stakeholders stayed in the deal. So I don't know what that translates to in terms of the stake that Tristan Capital bought, but they have bought it subject to a managing partnership already in place. We've also seen deals in Madrid, which has been a real favourite during the last couple of years. We've seen the Princesa Hotel sell for 175 million euros to Brookfield. We've seen the QO Hotel in Amsterdam sell for 110 million to Tristan again. They're on a real run. And we've seen some portfolio deals, some smaller portfolio deals, like it was known as Project Sereth in Spain, backed by 2 assets in Madrid and Barcelona, and that sold to a fund called Eurazeo for about 122 million. So we're certainly seeing deals, which is great. In a global context, you mentioned, of course, some of the extended stay deals in the States, George. One of the bigger deals, in fact, the biggest deal in the year so far, has been the Woodspring Suites sale of 111 assets for 1.5 billion. The highest price per key in the year so far has been in Jackson, Wyoming, in the US, for the Amangani, which was 2 million a key. And no surprises, it's a high-end leisure destination.
Yeah, great stuff. Thank you, Tom. And obviously the 1.5 billion Woodspring deal follows the 6 billion acquisition of Extended Stay America by the same partner. So they are really going full bore into that market. Lee, we were talking earlier before the call, and you mentioned that you're always on the lookout for assets in London for your platform. What would you say are the biggest challenges facing buyers and sellers at the moment?
Oh, yeah, that's a really, really good question. I think so I started focusing in on this model prior to 2019. And I feel that it still applies now, but I think with us all going through COVID the way we have done, it's accelerated these owner operators, these family run operating hotels, to want to sell their hotels. Like, that's typically what I'm finding. So if you think of it like this, typically you've got families that would have bought these hotels back in the sort of 60s, 70s. Capital appreciation has gone up massively, obviously in prime central London over the years. And they've done well. They've been good cash machines for a lot of these family run businesses. You know, they keep everything in house. And I'm talking sort of typically 50 to probably 200 keys, around that sort of number in terms of size of hotel. So not sort of like the small B&Bs, just sort of, you know, what I call a proper hotel. And I think COVID has really accelerated their mindset that they want to sell. And what I'm finding in general is that these owners, the younger generation, the sons and daughters, they don't really want to be, they're kind of well educated. They don't want to be running an operational business. Especially post-COVID. That's typically what I'm finding. So it's looking for the best way of how these owners can sell these assets. And that's kind of really very much where we kind of sit in the middle, is just trying to, I suppose, kind of given that level of expectation, because you can probably, there's a lot of sentimental value to these hotels because they've owned them for so long. They're like their homes. So they kind of have in their mind a kind of a price of what they want to achieve. And then on the other hand, we've got these private equity funds, some of the names that the guys have already mentioned, that obviously, you know, looking at these types of assets, and obviously everything comes down to obviously their return, their return on investment. So it's trying to kind of bridge that gap, if you like. And I think I do believe over time, over the next 12 months, and again, it'd be interesting to see where we get to with inflation, etc., that I think there will be there'd be more of a realization, I think, of these owner operators potentially sort of bringing their pricing down, more in line with where we need to be for these capital partners.
Thanks, Lee. Andrew, I think in the early days of the pandemic, there was an expectation that there was going to be a lot of distressed hotel inventory on the market. That didn't really materialize. Is that due to competition from buyers? Is it still a seller's market broadly, in your opinion?
Well, we certainly took the view at the time that there wasn't going to be a lot of distress, and that's because of the level of government support. There's still an argument that there will be some distress in the future because of the level of debt that some groups have taken on. I'm skeptical about that, actually. I really am skeptical about that. The thing that could cause distress, which we haven't really talked about, is increasing interest rates, inflation, all that sort of stuff. And there's several schools of thought as to how that would pan out. But I think, is it a seller's market? Well, yes and no. I mean, deals happen when the buyers think it's cheap and the sellers think it's expensive. That's when deals happen, right? So the print, in other words, the stuff we talk about is by definition when a buyer and seller's expectation meets. You don't really know, actually. It's very, very difficult to know, unless it's a quoted company, actually what the terms of a deal are, because you can have a deal with a big price, but a bad structure. That is sold by a seller who's actually desperate to sell, but wants to save face. So you can have a big price and a bad structure. So it doesn't really answer the question, because I'm not sure the question is answerable, George. But I do think, and this is probably the nub of it, to some of the points that Lee made. You know, there's a lot of money around, a lot of private equity money around, looking for mid to late teens equity returns, right? I think there's a lot of opportunity to get those returns with assets that are not distressed, maybe need to be repositioned, and we're involved in a number of situations like this, maybe need to be repositioned, right, or expanded or whatever. There's lots of availability of good quality opportunities that provide those sorts of returns. The problem right now is there's a degree of uncertainty in the market because of inflation and costs, cost of living, energy costs, etc. And one can take a view as to how that's going to pan out.
Thanks, Andrew. Tom, we recently ran a story on our Urban Living News website about the sale of a big purpose-built student accommodation portfolio, which Brookfield sold. I think it was a big transaction, about 3 billion, I think.
Yeah.
And there were quite a few bidders in for it, and at least one pulled out because their potential cost of borrowing had gone up so much while the due diligence and so on was going ahead. Is that likely to happen in the hotel market? Are some buyers going to pull out for assets which, you know, frankly looked a lot more attractive a few months ago than they do now?
Well, I can't comment really on that, but I would say that it's going to become an increasing challenge, not just for acquisitions, but also for groups that are refinancing and have to refinance this year. For example, the Grange portfolio is mooted to be up for refinancing. That's 800 million. And let's be honest, certain markets in London haven't performed strongly in the last couple of years, despite the strong leisure visitation. If they're not driving corporate business as strongly as they were, their cash flows are going to be some way below 2019. So that's going to be really interesting to study that. It was also interesting to see today that Investec have just announced a €1 billion debt fund. And their first assets are in the logistics space, so not really including hotels, but I wouldn't be surprised if they go into hotels, because increasingly these sort of sources are going to be needed by investors looking to gear up on acquisitions, even if they need to use mezz debt. But just coming back to the point about, is it a seller's market? I mean, I would say that for the last 6 months, if you've had a prime asset with vacant possession, with management availability, with everything that you possibly need to create your returns, your biggest challenge as a seller has been picking the buyer. Who do I pick from this long line? Now I think that that's somewhat changing, because what we don't know is that we don't know what assets aren't selling in the market, because there are some out there that aren't selling. There are some portfolios that have been pulled. There's a big portfolio in central London at the moment. I won't mention the name, but it's quite significant. It's sort of a 400 million deal. That's taken 6 months, and they're only just in exclusivity with a buyer. So there is a little bit of indigestion. I think there is going to be more price sensitivity, because I also think that underwriting will not be as aggressive as it has been, given the inflationary pressures, the interest rate pressures, the pressures of utility costs, wages, 50% rates going to 100% next year. I mean, I don't want to sound bearish, but I do believe that will will restabilize. It's not going to make the industry less attractive, but it's going to mean that it might be more accessible to buyers that have been keeping their powder dry until now.
Thanks, Tom. Lee, I'll come to you in a second, but Andrew, I just wanted to pick up on something that I remembered from a presentation that you gave recently, which was that while interest rates are going up fairly sharply at the moment, I think you said the medium to long-term outlook for them is fairly steady. So do you think we're just in the middle of a blip now, and that most investors' views won't be altered too much by what's happening at the moment?
Yeah, I mean, if you look at the structure of the capital markets, long rates haven't gone up much, frankly, in terms of bond yields and stuff like that. Short rates have, and that was the origin of the point that I made. So the expectation of the capital markets is that we're in an interest rate. We've probably reached the peak in interest rates. We've almost certainly reached the peak of inflation. It's on its way down, and this time next year or sometime in 2023, it'll be fairly normal. That's what the markets are saying, and there's a powerful argument to that effect, right? Which you can read about, and I'm not an economist, but there is a powerful argument to that effect. The counter argument is that that's far too complacent, and that we are at the beginnings of a major increase in inflation, and that will be reflected in interest rates, long-term interest rates in due course. So, as ever with this stuff, there's sort of two sides of the debate, right? I think the only thing that is relevant for our industry is to Tom's point. I think there is a lot of uncertainty around, and certainly deals are being pulled because of increasing debt costs. There's no question about that, and they may come back later on in the year. We don't know, but certainly there's uncertainty around that. There's also uncertainty around the mid-market, in terms of hospitality. I mean, the top end is going to do well, or are doing very well, and the bottom end will do well. It's the middle end, right, which is quite price sensitive. And, with certainly on the leisure side, with Spain and the Mediterranean opening up, then maybe that weekend away at a golf resort, whatever, is just a step too far when energy costs are going up, personal energy costs are going up. And we're certainly starting to see an impact in that particular market as well. So I don't know whether that answers your question, but that is my view.
Yeah. Okay. Thanks, Andrew. Lee, are you seeing heightened caution from your private equity guys when they're looking at deals now? Are they a bit more reticent than they were perhaps 6 months ago?
Yeah, very, very much so. And I think just coming on to both the points that Andrew and Tom have both said, I think from an underwriting perspective, when we're working with our equity partners, inflation, they're building in currently around sort of 9%. CapEx costs, we're adding in about a 25% extra on top of our CapEx costs, and then obviously things along, staffing, utilities, business rates, VAT, as Tom mentioned earlier. All those things are obviously having a big impact. And to Andrew's point earlier, trying to get that kind of sort of mid to high teens return for these guys, it is proving challenging. And I think that's where it really comes down to then, again, the point that Andrew made earlier, sort of repurposing the space, using technology the best you can, and really trying to drive sort of innovation through these hotels. To me, is kind of like that. That's the solution, if you like, but which outweighs the kind of the challenge that we've got coming up with the costs and stuff. And the other thing just to say is that obviously I'm just focused purely on London, but Brand London, obviously we've had a great weekend. Brand London is back. As far as I live in central London. I walk the streets every day, and it's busy. It's really, really busy. So I do believe that there'll be more people coming back into London, whether that's for kind of mainly leisure, but a bit of corporate as well. I think the kind of the type of guest has definitely changed slightly. I think definitely to your point of opening up into service departments and looking at that as a product as well as hotel rooms. I think there's huge opportunity around that space. Obviously, again, there's challenges around that. So yeah, I think it's really focusing in on a particular hotel or a portfolio, and just really seeing how you can sort of create as much value as you can from that because of these challenges that are there currently.
Are you seeing people looking to convert hotels to apart hotels and service departments, given the difficulty of recruiting staff and that kind of thing?
Yeah, very much. I mean, George, I was doing this pre-2019 of sort of taking small, I mean, at the time it's small hotels, small sort of boutique hotels, adding in kitchens, into rooms essentially. So I was actually doing this as a model way prior to COVID, sort of 2015, 2016, and it works. It really does work. And again, using technology, which is obviously improving all the time now, and has very much so over the past 2 years. So I definitely believe there's definitely opportunity with that. I think also when we talk about service apartments, as most of the listeners would be aware of, is that again with London, you have this C1 license that you have to comply by, this 90-day rule. So finding the right buildings to convert into service departments, that is a challenge. There's not many of those around, and obviously local authority are not keen to give out many of these kind of C1, if you like, hotel licenses, essentially. So yeah, I think that is a challenge, but I think but I see the opportunity with that as well if you can get the right blocks.
Yeah, thanks, Lee. So we've touched on service departments and extended stay, but which other asset types are the most and the least desirable at the moment, in your opinion, and why?
Well, I mean, without a shadow of doubt, at the moment, the resort markets are the must-have. Now, the question is whether or not they're peaking, and much will depend on how the summer numbers turn out in 2022, the visitor numbers. If we continue to have airport hassles and it's difficult to get people to the markets in Spain, then let's relook at this and let's see how we're doing, because for 2 years they've had a very, very poor seasons. It's all predicated on this return. So that's where a lot of private equity money is going in. They're ideally looking for big portfolio plays or platform plays if they can, or even picking off single assets. So that for sure is a key sector. But I would just say on that actually that if I had my money, I'd probably, and I was looking for more sort of stability and certainty of return from resort markets, I'd probably look at the US markets of California and Florida, where because of the drive-to nature of the business, they are back to their 2019 levels in both revenue and profitability. So we can buy there in, say, secondary markets of 8-9% going in, or prime markets of 5 to 6%. We've seen Henderson Park diversify by buying in both those markets. They bought Laguna in California, and they also they bought the Naples Grand in Florida. I think others more should be doing that actually, because it's a pretty good hedge, isn't it? But other markets, service apartments, of course, no question, very resilient during the pandemic. 50-60% occupancies versus 10% for hotels, say, during lockdowns. But coming out as well, because of their reduced cost base, it's a more resilient model to preserve margins. So more investors are looking at it, not surprisingly. One of the challenges we're looking at hotels converting to service apartments is you might get more profitability per room, but in a 200-room hotel, you might only convert to 150 apartments. So you've got fewer units. So that can be a bit of a challenge sometime. So those are certainly sort of two of the key areas. I think also the holiday park business as well. You mentioned a few things. We're seeing Butlins at the moment on the market. We're seeing Parkdean as well. You know, that's €2.5 billion worth. We've got about 3 billion potentially on Centre Parks, which is coming up. These are going to be pretty resilient going forward, because I think it's established that for domestic tourism, it's not just a passing fad. It's a sustainable industry now, because we can deliver luxury accommodation, we can deliver entry-level accommodation, mid-level, etc. So something for everybody. So I certainly think that that's a market to invest in as well.
Thanks, Tom. Andrew, is there anything you want to add to that in terms of attractive and unattractive asset types?
Yeah, I mean, I think there are two sort of other sectors that will see considerably more investment. One is going to be the technology, those hospitality businesses that are technology led. right? And we're seeing this a lot with the Numa LaSalle partnership. Bob W. in Finland, I think, just raised some money. And increasingly, real estate owners will want to own a product which is managed by the sort of the tech-focused hospitality companies. And related to that, and sort of in addition to that, is those hotels and hotels, etc., that make a real effort to become green. Now, I use those words advisedly because there's no standard definition. But what we do know is that the increasing numbers of people are concerned about this. And because increasing number of people are concerned about this and wish to stay in hotels and other hospitality venues which they feel as though is, shares those concerns, then funders will want to fund those, that sort of product. So it becomes a virtuous circle. And we're starting to see this in the US, and people say to me all the time, well, but how do you define this? Well, there is no definition right now. It's just people's gut feeling is the truth, right? Now, over the course of the next couple of years, there will be definitions. The International Sustainability Standards Board is in the process of defining accounting standards, which will really help us understand what being ESG really means. And following on from that, the various global regulatory authorities which govern bank capital requirements will follow suit. And so within a couple of years, maybe banks will have to provide less capital if they lend to those buildings or businesses that qualify for the ISSB ESG standards. So we're starting to see all this, and this will happen. This will happen, and it is happening. So I think that's something to look at for the next few years.
So we touched earlier on the rising cost of borrowing, but in fact, if you're looking to borrow towards assets that do meet ESG criteria, that could make your borrowing costs considerably cheaper in the future. Is that what you're saying?
Yes. I mean, we already know in the public markets that borrowing costs for green finance, we published a piece of research in this last November. It's on our website. Go to our website, you can have a look at it. And borrowing costs are at least 25, 50 basis points lower on a like-for-like basis. And that is going to accelerate. That is going to, the differential is going to increase.
Yeah, okay. Thanks, Andrew. Lee, you've said you're only really active in the London market, but are there specific types of hotels that have become more or less attractive in recent months?
I think in terms of number of keys, the focus is initially, if I go back to last year, it was sort of focusing on sort of 40 plus keys. That's definitely sort of moved up to probably more that kind of like 60 plus keys, because of all these factors of costs, obviously, that now being factored in, sort of thing, to get that return where we need to get to. So I think, yeah, definitely in terms of size of hotel is slightly increased with what I'm now focused on. And then I think in terms of again, just coming onto London, but location, just kind of focusing in on initially sort of zone one for me is the real focus, because when you look at the returns, just sort of when you come slightly outside of that, it's hard to try and match that currently in the current markets. That's what I'm finding.
Yeah. Okay. Thanks, Lee. Tom, let's talk a bit about who is actually buying and selling. Are there any specific buyer types who are very active? Who are the main players at the moment?
Yeah, George, there absolutely are. But can I just come back to the point that Lee was making about London and the types of properties looking at? Something that I've found certainly is that asset prices are really heating up in central London, meaning that for buildings that might otherwise have been converted to hotels and have hotel consents, they're going to other uses. So I'll give you a few examples of that, if I may. A building in Kingsway with a hotel consent for 300 plus rooms, that's going to be student block, okay? We've also got a fantastic ex-office building in Great George Street, which is going to be repositioned as a grade A office. So it's not going to be a hotel, although there's a hotel consent. Belgravia police station, a few groups were looking at for hotel conversion or service apartments, but that's going to be residential. So the market for in that sector of London is really being priced at by other uses, sometimes the other bed sector as well. But in terms of the dynamics in the market, who's in there, really, it's dominated by private equity, both buyers and sellers. Now, that could be opportunistic returns, but those guys aren't being as successful because they're not able to find the deals that deliver those 15 to 20%. The value add space where Tristan and Zetland are is proving quite fruitful for them. There's also core and core plus, and we're going more into institutional money. Interesting, LIM would be described as institutional capital. They've been buying ground leases at 2%, but now they're going into a sector that's going to give them more operational risk, which is a real departure from what they previously invested in. So that's really encouraging. We might see more funds doing that. PGIM are doing that as well. So that's really good. What we're seeing not so much of is private money and high net worth money. That's sort of keeping their money dry. They're sort of perhaps waiting for stability in the markets. When are the operating markets going to come back? When is the right time to come back? I don't want to take the risk today and lose my family fortune. I'd rather wait and see. So principally what is happening today is other people's money is being spent rather than their own money. That will change in due course. It always will do. And there'll be a time when private money is out competing everybody else. But that's when we have greater certainty in the world. At the moment, we don't have enough certainty for those investors to come in necessarily.
Andrew, does that tally with what you're seeing at the moment?
I must, with great respect to Tom, I must take some issue with what he's just said. Tom, apologies in advance, but the fact is most high net worth individuals invest via funds. That's the reality of it, right? Some don't, and they have a family office. There effectively are funds that are professionally managed that are family, like Sutton Estates, etc., that are family. But most high net worth individuals invest via funds. So I don't think you can draw the conclusion that high net worth individuals are not investing, because most of their investments are via funds. At the bottom end, you're probably right in terms of, but most of that stuff is regional, maybe 5 to 10 million in total. Used to be BPRA in some city centres, etc., etc. So I think the private individual market is more complicated. I think that the big family offices that have effectively their own professional management, you're right. You're spot on. I mean, they're much more wanting to wait and see, how the inflation stuff stabilizes, because they can. Many of them, I mean, certain estates have been around since the 1830s, right? So they're certainly not in a hurry. So with that exception, or with that comment, I do pretty much agree with what Tom is saying. However, Lee, I do think there's lots of opportunities to make 15% plus equity IRR, actually. With private equity, that it just needs, to your point, a little bit of imagination. It's repositioning. There's not, core plus is late single digits, early double digits equity returns, right? And if that's what you want, then that's what you want, and that's great, right? But there are 15% plus opportunities in development, in repositioning, in refurbishment, etc., etc. They're in London and they're elsewhere, and we're involved in some situations like that. So that's just a sort of, I hope that's helpful. Thanks,
Andrew. Tom, I was talking to an architect recently who said that fairly recently there's been quite a dramatic shift in attitudes of planning authorities, and it's politically driven, that it's becoming increasingly difficult to demolish an asset and build something new in its place. They're mad keen for repurposing. And the examples that you just gave, the Kingsway development, which I think is going to be operated by Scape, isn't it? Which is owned by SPG.
Yeah.
Are we going to get to a situation where hotel investors are going to have to rein in their expectations of a return if they're competing for these assets with, for example, build to rent or student accommodation? Or are they just going to have to let these opportunities go by and look elsewhere?
Well, there's a certain point at which they can possibly reach, and perhaps what we are finding at the moment is, and I don't want to speculate on which properties, of course, but perhaps some investors are sort of overreaching and they're outbidding others to get the assets, to get runs on the board. And it will remain to be seen whether those assets will prove up in the course of time. Because, you know, some of these reposition assets, let's be honest, there are numbers given by consultants, but with these rampant cost inflations, we don't really know what the capex costs are going to be in a year or so's time. And then if we add to the sort of the operational challenges with rising costs as well. So it's really kind of hit or miss. And I think what we're seeing is a market where, if anything, investors might be underestimating costs and overestimating future cash flows. Mm. That might well be changing in due course as we get more indigestion on deals, perhaps. But for the time being, it continues. I think the hotel market will be okay if it continues to miss out on some student deals. That's not a problem. But just coming back to the ESG question, and this is really relevant, because if you look at that Kingsway block, you know, it's a 1970s build. So considerable amounts of work has to be done on that asset to make it have green credentials today. Yeah. And there's often this discussion about, well, is it more efficient to knock down the building and rebuild it so it's absolutely state-of-the-art, carbon neutral today? Or is it better for the environment if we retain an older building that leaks more energy, but we're not knocking it down? So there's probably room for another sort of webinar on that. But you know, that's something that shouldn't be lost on us.
From what I can gather at the moment, the prevailing view amongst planning authorities is it's all about embodied carbon, and they're quite loath to see assets demolished, and unless there's a very good case for it. Andrew, obviously the funds are spending other people's money, but they are under pressure to spend it. It's no good to them sitting around doing nothing. So in these hot markets like central London, is it that kind of pressure to spend which is driving up prices, do you think?
Well, the answer is always yes, isn't it? At every point in the cycle, that's always yes. You know, the weight of money determines pricing. I think one of the things that has happened, and we talked about this a bit in the last 45 minutes, are these thematic investment partnerships, where, you know, the Point A deal was a classic one, right? Because actually what Christian did was they bought the welcome stake, right? The operator didn't sell anything, and there's a plan to build out more, to acquire more. So that theme was to build out Point A. And so we're seeing a lot of these thematic investment partnerships in order to get access essentially to deals where extra return can be created because of the relationship with the operator, right? Okay. So there's different ways in which funds can extract extra return by teaming up with asset managers or operators, you know, like that deal, or the C1 thing that we mentioned that we were involved with, or the live-in Blantyre relationship, etc. So, you know, there is a lot of money around, and there's more ways of investing it through teaming up with operators.
Thanks, Andrew. Let's talk a little bit about the runway and what we can expect to see in terms of transactions this year. Lee, let's talk to you first about the London market, and then perhaps Tom, you want to talk. You can roam a bit wider geographically speaking.
Yeah. I see the next. If we look at the next 12 months, I see it very much on the lines. To Andrew's point, I see very much where funds are partnering with operators and building out these platforms, as been mentioned so far with LIM and Numa as an example. So I definitely see a lot of that happening. I believe that. Personally, I believe there will be a number of hotels within central London coming on the market. I think the challenge is, like we talked about already, is that price expectation by the owner, the current seller at the moment, compared to what the buyer wants to be paying for. So that's the gap I think that will be bridged, and that will develop over this next year. That's very much how I see it playing out personally.
Thanks, Lee. And Tom, you very helpfully sent us some notes over earlier with some quite significant potential deals that are due to happen this year. Do you want to talk through some of those?
Yeah. I think firstly, I mean, London, as we said all along today, and Lee particularly, it's where you base your business. Firstly, just being on the street, you can see how busy it's getting, which is great. Is that translating to better hotel performance? Yes, I think it probably is in time. But if you go to the City of London, you might find a ghost town. So there's yin and yang really in London at the moment. But what we are seeing is some significant assets that are coming to the market, which might suggest that certain sellers or owners think that this is the best time to be selling and getting some chips off the table for whatever reason. The Hard Rock Hotel is 500 million, and that's on a lease basis to GLH Hotels. That would probably yield about 4.5% in 2023 off the rent projections, which will appeal to some investors who have got a lower cost of capital than others. So it's more institutional capital that will probably be going for a deal like that. But it's a sizable chunk. Let's just see how that goes. The Holiday Inn in Kensington is up for grabs as well. That's vacant possession. So there are opportunities to rebrand. It's the perfect blank canvas. It's in a price-sensitive market, though. Kensington is no question. But even on something like that, if you can push the rate from, say, 100 quid to 130 quid, that might translate to 5 million on the bottom line on a large hotel. But the question is whether the private owner will be able to sell at the price he wants. And if he doesn't, is he prepared to say, no, I don't need to sell it? And it's probably the latter. He probably won't sell it. So there's a little bit of market testing perhaps going on at the moment. There's also the Dilly on Piccadilly, which is on the market at the moment. And, you know, that's a vacant possession opportunity in one of the best locations in London. But there are challenges with the leasehold interest because it's sub 100 years. So there might be some investors that say it's just not for me. So we'll see how that one goes. Bids have come in on that property already. But if we look around the provinces, in the last 24 hours, I've heard of a significant hotel platform which has just been launched at a pricing level of sort of north of 550 million. And again, to many people, it might be the dream ticket. You've got the operational player, you've got the asset player, you've got the brands, you've got everything you could want. You could grow and build it. And it's a sizable deal to allocate a significant chunk of cash to. So, you know, this is going to be occupying a lot of investors' minds at the moment. So the UK will be, no question, pretty busy on the deal front. We're also going to see more activity in Spain. There's a large portfolio there, which was mooted to be sold or on the market a few months ago, but I think it's being pulled to later in the year. That's about a 700 million deal. That deal will actually be offered with vacant possession. So it's going to be widely sought after because that kind of opens the door to so many variables in terms of pricing as well, rather than being encumbered. Investors invariably do not want to be buying into 700 million deals on sale and managed back or lease back. Ideally, as Andrew said, they want to be going in there with their management partner to come in to, I suppose, create their own future with the brand and the operation rather than being run by the brand, so to speak.
Yeah. Thank you, Tom. Right, we've got some questions coming in from the audience, so let's get on to some of those. The first one is from Chiara Pellizzari. Thank you for your question, Chiara. And she is asking about a market we haven't touched on yet. What do you think about Italian hospitality transaction market? Which are the main challenges the market is facing, and which are the most relevant deals to be monitored in Italy currently? Who would like to kick off with that one? Tom, do you want to go first with that?
Yeah, no, I will actually. I mean, I would say the biggest challenge with Italy, no disrespect, is transparency. And the challenges perhaps of buying a hotel from not just one family, but from 3 families can be challenging. So I think that should be considered when going into the market. But we have seen some significant deals. We've seen Blackstone come in and buy Mangia Resorts, which again is a platform deal. They've got the brand, they've got some asset-backed resorts. So when groups can get in, they will get in. We've seen Bain Capital buy in Lake Como, which is a phenomenal property. and that will be rebranded, repositioned, and I'm sure they'll do very well there. It's a tremendous place. And we've seen ECE partners buying Venice. Venice is the perennial favourite. Everybody wants to be in Venice. So I think if opportunities arise and they're genuinely for sale from committed sellers, then we haven't got a problem with Italy. I think a lot of people will go to Italy.
Yeah, so I mean, we hear a lot about Spain and Portugal recently, but the market fundamentals in Italy are still strong.
Yeah, no, unequivocally. And if you look in the markets like Milan as well, I mean, certainly I've been looking for service departments in that market. That's a core market, obviously corporate backed as much as leisure backed, but it's a resilient market.
Yeah, thank you, Tom. Andrew, did you want to add anything about the Italian market?
No, I think Tom's nailed it. I can't add any additional value.
Okay, we'll move on to our next question from Thierry Vidmer. Thank you, Thierry. While the industry currently expects the inflation shock to be temporary with a sideways shift thereafter, how does the panel feel about customers starting to feel the pinch in their wallets? For 2022, we see amazing figures with a do or die attitude to revenge travel, revenge in brackets. But the impact of energy, cost of employment, do we think this can and will translate into income and revenue inflation, or might we get caught out? Andrew, would you like to kick off with that one?
Yeah, I think basically what I said before, the top end of the market, prices will go up, the hotels will be full. You know, they've got no doubt about that. The bottom end of the market, you know, I think that will continue to do very well and be able to pass on costs. There'll be a lot of investment at the bottom end of the market, as I mentioned, in technology, in little things like maybe you pay extra if you want daily cleaning, all that sort of stuff. But I think they'll be able to deal with it. It really is the middle end of the market that I worry about, actually. The mid-market I worry about, because generally the people who go there are, you know, are on a budget and certainly have been impacted by the cost of living. And I think that's going to suffer. But one thing, but generally speaking, hospitality has been able to put up prices to compensate for cost inflation. Generally speaking, it's a good market to do. It's a good area to invest if you want some form of inflation proofing. I think you just got to be selective which part of the market. I mean, apart hotel service departments are definitely a great place to invest under those circumstances. The shortage of supply, I mean, all the things we've been talking about. Costs are, you know, it's select service, so you don't have, you know, the same costs you've got in a full service hotel, etc., etc. And my final point is to quote one well-known hotelier who has 30-odd apart hotels around Europe. I had dinner with him a couple of weeks ago, and he said, yeah, what we're doing is we're going around each of our buildings, and we realise that when the building is open, the temperature is set and it stays there forever. So what we're doing is we're turning down the temperature, and we can save 20% of energy costs. So there'll be a lot of people who are forced, there'll be a lot of businesses that'll be forced to cut costs, and certainly there's a lot of costs that can be cut. So that will provide a bit of protection too.
Yeah, thanks, Andrew. Lee, presumably a lot of the assets that you were involved with are mid-market and then are being upgraded. Do you share Andrew's concerns about that particular segment?
Yeah, I do actually, and it's definitely something we're factoring in when we're doing the underwrite. So very much so. I mean, there is a concern of how much money is going to be left in the pocket, you know, as we get towards the end of this year. As you said, it's definitely going to have a bite on everybody. So, but like I talk about sort of repurposing and adding value into these sort of hotel spaces, if you like, I'd also say the same with when you're talking about guests. So it's about adding value to guests to make them feel that, so you're not necessarily, they're not looking at it as thinking it's oh, this is really expensive. It's like, this is good value. And I think there's a number of ways of how you can do that with a guest. And so I do believe very much it's about just really thinking outside the box slightly for the guests of 2022, 23, if you like, and really trying to work with them to get them to come in and stay in your hotels. And then the final point is, I think on the cost side, and Andrew just mentioned it there, he talks about heating. I mean, there's some great tech out there that basically controls things like this. So as opposed to having to run around the buildings, and I know that's obviously Andrew's just sharing that point, but you know, there's technology out there that can really help with turning lights off, keeping heating down, changing temperatures, etc. And this, the price of this technology is so much cheaper now than when it was a few years ago. So I think, like, from the investment perspective, I think there's some good opportunity there for hoteliers to be looking at too.
Thank you, Lee. Right, we're nearly out of time. It's been a fascinating conversation. Before I get on and show a couple of slides to wrap up the session, I'm going to give each of you gentlemen a fictional 100 million quid to spend on a hospitality asset, and I want to know what you're going to buy with it and why. Tom, you first.
I'm going to buy 2 hotels in Times Square, New York.
Okay. You want to give
the reason why is
I don't guess why, but do you want to elaborate?
Yeah. The reason why is, like, there is distress in that market, in the big box market in New York. We all know that, and the prices are probably less than half of what you'd pay in London. And New York is a forever city, so is London, so is Paris. But for some reason, at the moment, it's not widely fancied, and it will come back. It might take a little longer, but that's probably where I'd speculate. It would be risky capital, I suppose, but it might double my money eventually. Yeah,
thanks, Tom. Andrew?
Tom, you're not going to get much for 100 million in Times Square, New York. I have to tell you that now. But your point is well made. I would buy an apart hotel in central London, a high-end apart hotel in central London with 150 plus keys. Well, actually, probably wouldn't get it for 100 million, but you know what I mean. If it's 100 million equity, maybe, and then you leverage up. Yeah, definitely. We're underserved. The market's underserved. It's a great product. It's a great business model. It always was a great business model. And what COVID has done, it's highlighted the business model. The fact that they outperformed the market meant that people looked at the business model, which in normal markets is really good.
Yeah, thanks, Andrew. And have a word with Tom. I think he's got an operator who might be interested in your asset.
Okay.
Lee, finally, over to you.
Well, I am going to agree with Andrew. That's the short answer. I definitely agree that that's the way to go. And I think, and just following on from that, as I've answered that question very briefly, is that when I started my first service department in central London over 20 years ago, I had to educate corporates as to what a service department was. Like, it's a hotel room with a kitchen in. I remember having so many conversations with corporates many years ago. COVID, as Andrew said, has accelerated this product now, and I feel that is definitely, that to me is the future. Is that kind of self-service hotel / service department. That's where I'd put my money.
Great, thank you, Lee. That's a good note to end it on. Just going to show you a couple of quick slides before we sign off. And we're going to leave the session open with a countdown clock for a couple of minutes afterwards, so you can take some notes on all the information that's in the chat. There's quite a bit in there. So the next Urban Living webinar will be on Wednesday, July the 20th, and it is about another really interesting and vibrant sector at the moment, and that's build to rent. So you can see a link to register for that in the chat, or you can scan the QR code on your screen. Just wanted to mention our flagship event, which is taking place on July the 6th and the 7th, the Urban Living Festival. It's looking at how hospitality and real estate asset classes are converging and how urban development is changing. Again, you can see links to buy your tickets there. Here are some of our speakers you can see on screen coming from across various asset classes. We've got investors, developers, operators. Going to be a fantastic event, so it'll be good to see some of you there. If you're interested in sponsoring any of our webinars or our events, then please get in touch with my colleague Katie Harrington, whose details are on the screen and also in the chat. And if you're active on any of these social channels, give us a follow. We're pretty active, and it would be good to see you on there. All that's left to say is thank you to Lee, to Tom and Andrew for their input today. It was great stuff. Thanks to you all for your time. Thanks to Flywire and Charles Hope for sponsoring, and see you on the next webinar. Take care, everyone. Bye-bye.